Now, as we know, the interest, keeps fluctuating. Interest keeps going up, going down, depending upon, the market situation, economic situation of the country. World over, the interest rates keeps changing. It never remains the fix. Okay, so it's all basically a demand and supply factor, which leads to interest rates either going up or going down. And of course, there is some intervention by RBI, okay, in case if there is inflation. So their first objective is to bring the interest rate down or make it up. For example, if there is a lot of inflation, so they raise the interest rates, which actually brings down the inflation. Okay, so the RBI's objective is to, manage the interest rates through their policy intervention by increasing or decreasing the repo rates and other kinds of ratios, which they always talk about. So, of course, I've covered in my slide all these things, which I'm not going to cover now because you have done your, interest rates, you know about, you have economics, you have studied. Okay. Anyway, Haji. Okay. Okay, fine. So no issues. We'll talk about something about the repo rate, which will be there. So interest rate risk management, because the interest rates is something which can affect the companies, okay, their bottom line, but particularly. Why do companies need interest rate risk management? So you can see the slides coming there. Why do the companies need interest rate risk management? Okay, because the interest rates go up and it can impact adversely their profits, and as well as there are some companies which are their business is on the base of interest rate. If the interest rates go down, people buy their products. For example, all the white goods or cars, all the companies which or housing. People buy houses when the interest rates go down, and when they go up, then people shy away from taking loans. So many industries, they are linked to interest rate either directly or indirectly because their business impacted, or it's because they borrow a lot of money which can impact their interest cost. Okay. So now, what are the factors? Why do companies need interest rates? Anybody can just read this. Who's Yeah. Okay, so change in interest rates can lead to increased borrowing cost or reduce income from investments. Suppose when you're making, when you're taking a loan and interest rates goes up, then it will cause a kind of interest expense to go up, and thereby your bottom line will impact it negatively. Okay. Similarly, if you have parked your money somewhere as an investment, it will, if the interest rates come down, it will reduce your investment income. So it can, impact both ways. Positive. In a companies, if they have investments, they'll bring less returns. If they are borrowed money, it will impact their bottom line adversely. Okay. Then second, so this is already we have done that. Volatility is basically there's a lot of volatility. So people don't like, businesses don't like volatility. Okay, because they will find their balance sheets are getting impacted because of that. And second is when you take loans, it increases your cost of borrowing, which is actually part of the first itself. Okay. Second is asset liability mismatch. Okay, just read that. Now, as we know that banks or financial institutions, they have हाँ ध्रुव मैं ले रहा हूँ एक क्लास ले रहा हूँ साढ़े 12:45 पे हाँ okay. So financial institutions with mismatched durations of asset. Now, whenever there is a bank, they have what? They have given loans, okay, which is their assets. Fine. From there, where they get the money? From saving account, fixed deposits, current accounts, and they also borrow money. So all that money which they, procure from either from depositors or from borrowing, so they are their liabilities and they have to pay interest on that. Similarly, they have assets which are, whatever money they have got, they're going to lend it to someone as corporate loans, housing loans. Okay. So there is always a mismatch durations because generally the housing loans would be, like 15 years loan, 20 years loan. Whereas, the money which is coming from fixed deposits, they are for 1 year, 6 months, saving accounts, they are for shorter duration. Okay. Particularly the time deposits. So that creates a mismatch. Okay. So, and banks have given loans to someone, a housing loan at say 7% or 8%, and the rate of interest keep changing on their, on the liabilities which they have taken in form of deposits. So it can impact their profitability. Okay. Now they can't change immediately the housing loan interest based on what they have actually money which they are given on deposits. So if the rate of interest goes down, they incur their profitability will be impacted because of that, isn't it? So so these companies are basically highly sensitive to the interest rates. Okay. So if I just read this. Is that okay? Have you got it? What I was explaining that they have given loans which have a longer duration generally, a housing loan or any corporate loans which can be 5 years, 10 years. Okay, the rates are generally given at the time when a company takes a loan, and those normally remains the same if they are not on a floating rate basis. If they are fixed, then it will remain the same. But when they borrow money in form of deposits, that is only for a short duration. And if the interest rate goes up, so the new deposit will carry a higher cost for the time deposits or fixed deposits. So which will create a mismatch between the loans which the companies have given, and that can impact the profits of the companies. Is that okay? अगर इंटरेस्ट रेट कम आ रहा है ज्यादा आ रहा है ज्यादा हो गया है so they have to pay more interest on a fixed deposit, and what they are getting from the assets will be lower, so it will impact their profitability. Is that clear? Okay. I just actually I just kept it to the last. So look at the balance sheet of a bank. This is a balance sheet of SBI. Okay, where we talk about, it starts with liabilities and assets. Liabilities at the top, capital, reserves and surpluses, minority interest. Then we have the deposits and borrowings. So this is the line item which I'm talking about. So they have deposits to the worth of 26 lakhs 40,000 crores of, they have deposits in form of, money received from depositors, and they have also borrowed 2 lakh 54 2 lakh 54,906 crores. So that makes about 29 to 30 lakh crores. Okay. So the corresponding number which will be there will be in form of advances which they are given as loans, and the investments which they have parked the money in form of, in form of some investments like GSECs, government securities which are earning interest for them. So this investments and net advances. So this is around close to about 30 crores. Okay, 30 lakh crores. So they have 30 lakh crores got from the people, which form of, saving accounts, current accounts, fixed deposits, and they have also borrowed some money to give loans to the people. Okay, borrowed cheap and giving loans and earning a margin on that. So this is the money which they have in form of the upper ones are liabilities. So that means they have the bank needs to pay, okay, to either the customers or to the borrowers, and these are the assets on which the company earns interest. So this is a income earning assets, that is advances and investments, and those are the interest which they have to pay. So the interest earned minus interest paid becomes the income of a bank, and that is called the net interest margin of the bank. Suppose the bank is paying, say, bank is getting 10% and paying 6%, so their net interest margin will be 4%. Okay, so that's called NIM basically. Whenever we look at the bank, so we see a figure called net interest margin. Okay, so when we see all the banks in India and see which bank is earning the highest net interest margin, like how much State Bank of India is earning, how much ICICI Bank is earning, how much SDFC is earning. So they are all in the vicinity about 3.5 to 4%, okay, or maybe 3 to 4%. So their income or their profit gets affected because of the interest rate changes, because they have given loans, okay, with in form of what I mean advances and investments, okay, net advances. So they have given loans to someone at certain rate, and they are to service those through by way of paying interest on deposits. Okay, so they, and as I told you, loans are for a generally longer duration, and interest which they are getting in form of deposit, they are normally of a shorter duration, isn't it? So this can impact. So there is a mismatch in the duration, which can impact the profitability of the company. We're coming back to that. Hanji? No, no. The balance sheet of a company would always be a matched balance sheet. Like when you're making a balance sheet of any company, the asset side and liability side will always match. Okay. For example, show you because you haven't studied accounts. Suppose you start a business. So you get an asset of say 10,000 rupees. Right. So this is your for the company. This is a liability. Okay. Now, liability for the person who is the owner of the company and the company are different persons. They have different entity. Okay. Because the law is concerned. So this is a liability for the company, and the asset side will be bank balance. Suppose this is the way the company has just started the business. So they will have 10,000 in the bank, which is an asset of the company, and on the corresponding there will be an asset. So suppose you start a business with a scratch, so you give 10,000 to your company. So you have always a match number. Okay. Like suppose from this 10,000 you bought something. For example, you bought a furniture for 5,000. So the bank balance will go down to 5,000. So obviously your balance sheet will be matching. Okay. So this way, whatever transactions you keep incurring, keep doing it, your balance sheet will always match. Okay. First you started with 10,000 rupees capital, so entire money was your bank 10,000. Then you bought some furniture or some machine for doing your business. So you purchase that machine and the bank balance get reduced, your asset will become 10,000. So all the time your assets and liabilities will be always matched. Okay, so for all companies, the balance sheet the company, anytime they prepare, it will be a balance. So there is no case where the balance sheet will be mismatched. If it is there, it will account again. Okay, fine. So let's go back to. So then, so three reasons why do companies need interest rate risk management. One was volatility in cash flows. It can impact the cash flows of the company, how much they're earning, how much is the cash they're generating because interest rates keep going up and down. So it can impact their cash flows. Second, the cost of borrowings can go up or go down depending on the interest rate. Going up, cost of borrowing goes up, and the company's profits comes down. And the third one was the asset liability mismatch. Generally, it happens with the banks when or financial institutions. Okay, it can happen with any company, but it can be better explained for all the financial institutions. Now, regulatory reporting requirements. Okay, now all the companies in India, they have to, uh, uh, all the companies which are listed on the stock exchange, particularly. Okay, so there is something called corporate governance. So all the companies have to follow a certain, governance. So they have to use the assets, in a very optimal fashion. Okay, and they are subject to audits, everything. So companies have to prepare a risk management strategy, how they are going to manage the financial risk of the, because of course businesses itself is risky, but there is something called financial risk also, which we'll going to talk about in our coming part of the slides. So all the companies, they have to, a committee is carved out of the board of directors, which is called the risk management committee, which talks about how they are going to manage, how they are going to manage the foreign currency risk, how they are going to manage the interest rate risk. Okay, fine. So they have to form a committee and keep reporting thing how they are managing their companies. Okay, Hanji. It is legally mandatory. They have to make a committee which will talk. Of course, now it is something like they have to make a committee and they are going to design a program how they are going to manage their risk. Okay, and then they talk about in the subsequent reports how they have done it, what was the kind of risk they had, and how they managed that. Okay, for listed companies it is mandatory. For unlisted company it is optional. Okay, fine. Then the valuation impact. Now, all the companies, as we know, the price of the shares of the companies keep changing. So all the companies want their valuation to go up, isn't it? If you look at, for example, I'll just, here share this thing. Enterprise value. Okay, that's a good thing. So we'll talk about that also. Okay. So so there's a site called Screener, if you are aware of that. Aware? So here you can put any company's name, so you'll get the company's details. Okay, fine. So what I was talking about, companies valuation. Now, the companies today, when you look at Reliance, if you want to buy all the shares of company of Reliance, 100%, how much money you should have? 16 lakh 98,583 crores. So this is the value market cap, which means the total shares of the company multiplied by the share price prevailing today in the market. So today in the market, the share price is how much? 1255. Okay. And what is the total number of shares? 1353. So if we multiply 1353 with 1255, you will get this number. Okay. If I just show you that, just do it on a calculator. 1255 multiplied by 1353. So this is 1353 is crores. Okay. Number of shares. 1353 crores. Okay. How much you're getting? Okay. So which means the current price of the share multiplied by the number of shares which the company has issued. So company has issued 1,353 crore shares. Okay. And the current price is 1255. So if you multiply this with this, so you get the market cap. Okay. So this is the market value of all the shares of the company. Okay. Now you're talking about enterprise value. Okay. So if you want to look at the enterprise value, it will be very close to the value of the market cap, which is 19 lakh 65,755. So, uh, so आपने enterprise value बोला था तो उसके have you learned somewhere or how do you know about what is enterprise value? Have you ever heard about enterprise value? अच्छा आशीष पांडे सर ने बताया था ये वर्ड. Okay, okay. No, no problem. Because I thought you were knowing it, so let me just. हाँ उसमें क्या होता है एंटरप्राइज वैल्यू निकाल एंटरप्राइज वैल्यू इज नथिंग बट द प्रेजेंट वैल्यू ऑफ ऑल द कैश फ्लोज विच द कंपनी इज गोइंग टू अर्न इज इक्वल टू एंटरप्राइज. हाँ absolutely. So let me just talk about a little bit here about that, okay? And just to refresh to that. Now, all the companies, they want to increase the value of their company, okay? More the value, better it is, okay? Now, if you look at Reliance, which is having the highest value in terms of the share value, okay? Not the entire value of the company, but the value of all the shares, okay? Fine. So that is how much? 16 lakh 98,000 crores. Okay. Now, this is the India's highest this thing. The followed by maybe TCS or HDFC. So let's talk about HDFC. So if you see HDFC, the value is 14 lakh 14,000 crores. So maybe this is the second one biggest company in India in terms of the market cap. Let's talk about TCS. TCS will be TCS is the second biggest, 15 lakh 91,000 crores, followed by HDFC Bank. Okay, so all the companies, when you look at the company, so you want to know what is the value of that company. If the value is greater, you feel very happy this company is very big, and if it belongs to you or you're the shareholder of the company. Okay, so Reliance has the highest market cap in India, and the biggest company in the world is called Apple, which is about like 3 to 4 trillion dollars, almost equivalent to India's GDP. Okay, so their market cap means that what is the total value of the shares is much higher. They almost like it is equivalent to India's GDP itself. Okay, then followed by other companies like Walmart, or maybe sometime the Facebook was also in the top five. So these are so all companies would like to improve their market, their valuation. Okay, so their job, all the companies, first of their objective would be how they can increase the value of the company. And one of the component is called the market cap. The second component is called the total assets of the company. Okay, how much assets they own. Okay, now the assets are financed through either the equity or through debt. So either the company can take a loan or company can use their own capital and they buy their assets. So it's a combination, which is nothing but the enterprise value. Okay, so this is coming as enterprise value is much higher because it includes the money which is being borrowed from outside. They have been also deployed in creating assets of the company. So that's why you will always find uh, the enterprise as value as greater. This is 15 lakh 84,000. There it is 8190. Why? Because the TCS usually don't have any loans. Okay, fine. TCS is a company which will have a very less amount of loans. Suppose if you look at a balance sheet of the company, if you look at the loans, their borrowings are hardly very less, 9,000 crores. Okay, but if you look at Reliance, this figure will be, phenomenal. So if you look at, for example, Reliance, okay, look at the balance sheet of Reliance. So first is equity capital, how much? 6,766 crores. Reserves, which belongs to the shareholders, 8,12,000 crores. So, and loans, 3,57,000 crores. So Reliance is having one of the highest loans in India because, Reliance needs a lot of money. It's a very big company. It's a conglomerate which is present in about six or seven businesses they're doing. Oil business, they're doing tech, they're doing, retail business, they are in telecom, they're in many kind of businesses in India. Okay. So they require huge amount of capital and all the money they cannot take from shareholders. So they have to go and take some loans also from the banks, or they have to borrow from somewhere else. So this their borrowing is about 3,57,000 crores. Now, the second item which we are showing is equity and reserves. Now, reserves belong to whom? The shareholders. And how are the reserves created? Any idea? Reserve कहाँ से आते हैं? Now, when a company does business, okay, when a company does business, they earn money, isn't it? When they earn money, the money belongs to the shareholders. जो profit होगा company को shareholder का होगा. Now, they can either give that money to the shareholder in form of dividends, or they can put the money back into the business for growing the business. Okay. So whatever they give money as a dividend, that the money goes out of the company. The money which remains in the business, so in form of retained profits, the company has earned profits, but they have not distributed. They have deployed it back into the business. That is the reserves come from. So this is the reserve the company has generated out of the profits, past profits which they have earned and not declared as dividends. Have you got it? So this is almost like 60 to 70 to 80% of the money which is lying here is out of the profits which the company has earned but not declared as dividend. Okay? Fine. And of course, there are some other ways through which the reserves can be created. Like suppose the company comes and issues more shares to the public. Suppose 10 रुपए का share है. Now, a company like Reliance is issuing shares, fresh issue to the shares to the shareholders. They won't issue at 10 rupees. They are going to charge a premium because company is already a big company. Okay, it's highly valued. So when they give the shares at 10 rupees, that means the new shareholders will become the owners of the entire company. Okay, all the assets will be owned by them in proportionate share. So they give that right only if they collect a premium from them. Okay. So if you are new to the company, so you have to give a premium, then only you become part of all the assets of the company, isn't it? So the amount which is equal to the valuation of the company they have to give, which is called the premium. Whenever you find there is an IPO, FPO coming in the market, they are issued at a premium. Okay. Because it depends on how valuable the company. For example, I was working in a company like ISL, or now it's become Vodafone Idea, long back. So we came up with a IPO. The first time when the shares were offered to the public, so we were already having a value of 10,000 crores because we had assets, we had towers, we had land, we have buildings, so it was already valued 10,000 crores. Now, if you wanted, and Tata's, Birla's, and AT&T, they are the only three shareholders of the company. So now they wanted public should participate in that. So when they gave the shares, they gave up shares at 10 rupees, the premium of 70 rupees or 60 rupees. So the share price was 70 rupees in the market. So they collected 60 rupees from the new shareholders so that when they come to the company, they will be owning all the assets which the company already owns. So they'll have a proportionate share. So they can't allow anyone कि भाई आ जाओ और ये 10,000 करोड़ के शेयर आपकी सॉरी एसेट्स जो है आपके हैं अब तो उनको प्रीमियम देना पड़ेगा. So all the companies they charge premium whenever subsequently they raise capital. So that money which is collected will also go and sit in reserves. Now this money which they are collected as a premium will actually belong to all the shareholders now in equal proportion. Of course, they have been calculated from the new shareholders, but they will become they will be belonging to all the shares in the ratio of the shareholdings they own. Is that okay? Right? So now that constitutes almost like 90% of the reserves. अब ये reserves जो आ रहे हैं ये दो sources से बने हुए हैं. एक तो retained earnings, the profits which the company has earned but not declared as dividend. Second, the money which they have collected from the new shareholders as premium, okay, to bring them and become at par with the existing shareholders. So the premium which they collected will be sitting here in this money reserves. So 90% a asset reserve created. Of course, 10% there can be some others. For example, another one. Like suppose if a company become very old, 100 years old, 50 years old, or 20 years old. So sometimes they value their assets. Like suppose if I own some private property in Kolaba, okay, there is a big office of, say, Reliance, which is they bought about, say, 50 years back or 30 years back. Now that property is they bought was 1 crore, now it is, say, 1,000 crores. Okay, so what they do, they will restate their balance sheet and bring that asset at 1,000 crores. So that 9,990 crores will always go to the reserves. वो भी पैसा इसमें चला जाएगा अगर आपने अपनी asset value revalue करी है and it is now more than what price you paid to acquire it, so that will also become part of the reserves and it will again belong to the shareholders. All the building, everything belongs to the shareholders. It was valued at 1 crore, now it is valued at 1,000 crores, so it will appropriately be shown into reserves. So capital appreciate जो भी होता है that's shown in the हाँ जी जो भी capital appreciate होता है that is not to reserves. So any money which is not being given back to the shareholder in form of cash, either way of dividend or whatever way, so that will always be reflected in reserves. Now reserves, there are three main reasons for reserves. When I told you that constitute almost like 80 to 90% of all the possible sources. One is called what? Profits earned in past, not declared. Second? Capital. Increase. Fresh issue of capital at premium. So the share premium which is collected will also sit part. Third, at least the revaluation of assets. Which the company owns, if you revalue your assets and you know the values have appreciated over the time, so the appreciated value, the difference between the value what they bought and what price which you are showing now in the balance sheet, the difference will go to the reserves. And the other difference will go on the asset side is part of the building. Okay. देखो क्या होता है यहाँ पर fixed assets है यहाँ पर total fixed asset which is also includes the building of the company. Okay. Now the building value will go up here and here. So assets and liability will again match. जो यहाँ पर appreciation दिखाया था वो यहाँ चला गया और building की value बढ़ गई वो fixed asset में चला गया. So always the balance sheet will always match. Is that okay? Now look at this balance sheet. Have you ever looked at the balance sheet of a company? ये देखिए आपने ना? Achha, you are BCom honors, okay, fine. So you know, if you look at the balance sheet of the company, we'll have just explain this is the capital, which originally brought by the shareholders, which is the face value of the capital, and then the reserves which are keep adding, piling up as the company becomes more and more profitable, and the money goes into the reserves. Third is borrowing. So that means company will get some money from outside to do the business. So this will become a liability. So some other liabilities also, which can be any other liability, which like suppose the company has to pay a telephone bill, electricity bill, or whatever. So all these are becomes the total liabilities of the company. Okay, just have this thing to understand how does the balance sheet look like. So this is all liabilities. Is that clear? Any questions here? Now, what are the assets of the company? Now, company has used all this money to acquire assets. Okay, they have made refineries, they have made offices, buildings, machinery, equipment, plant, IT equipment, computers. So all are coming and shown in the fixed assets here. Then company has certain assets which are under creation. Suppose the company is making a new building. So this will capital work in progress. That means company is making a new factory. Okay, so till the factory is fully constructed, it will not go into fixed assets. It will be shown into CWIP, capital work in progress. So this is work in progress. Ultimately, they will become part of the fixed assets. Then investments. Now, company can always make some investments. So whatever money company is having, company can park it for some time when they don't need money. Okay, they're sitting with a lot of money. So they would park some money in form of some investments. Okay, like they can make investment and buy another company also. Okay, suppose they bought 10% stake of a company, 20% stake of the company or another company. So they will all be investments. So these are investments are not that they put money in fixed deposits or in form of shares. They are also in form of investing in other companies up to 50%. But beyond 50%, that will become the part of the company and it will be shown as consolidated figures. Okay, so it will be reflected into it will be merged with the balance sheet of Reliance. Okay, like suppose a company, India rule is or everywhere in the world it is rule is that if you own the company more than 50% share of the company, you become the holding company. Okay. Okay. Now when you are making a balance sheet, combine of all as well as your subsidiary companies. Okay, fine. But till you are not having less than 49%, less than 50%, so they will be shown as investments. Okay. So here the investments are those where the company has invested say money which is less than 50%. So they are still companies which are not the subsidiaries of Reliance, but they are the investments. Because here what I can do is I can just show here. For example, this was if I say view standalone. So when I say view standalone, now look at the fixed assets of the company, 3,60,000 crores. But when I make it, for example, view consolidated, so the figure will be how much? 9,60,000. Gone up, isn't it? So all the companies which are subsidiaries of Reliance, they all become one company of Reliance. All the assets and liabilities will be merged. Because here the company has become a big company where all the assets of its subsidiaries will become part of the holding companies. Okay. But now the second question would be, now there are some minority shareholders. Look, suppose the company has got 80% share in another company. So 20% belongs to some third party who are not the owners. I mean, Reliance still not owning those shares, so that will go to somewhere as minority interest. Okay, fine. So I'll show you there is a figure called minority interest. So they'll be still matching the balance sheet because some part of the company will not belong to those people. Okay, so non-controlling interest. Okay, fine. Suppose a company, Reliance owns, say, 60% of another company. Okay, fine. So what will happen? It will merge the balance sheet of that company. All the assets will be merged. Suppose the Reliance owned 100 crores and the subsidiary company owned 50 crores, it will become 150 crores. It will be shown as a fixed asset. Fine. अब उसमें जो company is holding only 60%, so 40% of the assets is not owned by Reliance, isn't it? It's owned by someone else. So there's a liability towards somebody else. Okay, that liability will be reflected here, 1,34,000, non-controlling interest. So this is the non-controlling interest part, minority interest. So again the balance sheet will get merged. अगर हमने दोनों ऐसे मिला दिए, तो फिर वो सारी कंपनी रिलायंस की है नहीं, कुछ कुछ पैसे कुछ कंपनी कुछ ऐसे भी एसेट्स हैं जो कुछ पोर्शन जो है वो दूसरे लोगों को बिलोंग करता है. Okay, and that is getting reflected as non-controlling interest. Is that? I mean, this is all accounting, so I'm just showing you. Now, so we have investments, other assets. So total मिला के अब other assets में क्या है? Cash balance or maybe something else, maybe receivables, some money which you have. I mean, some customers of Reliance, they have to give the money to the company because they have sold certain products to them. For example, they have inventories also. Okay, so because the Reliance will be holding a lot of assets in form of inventories. Like suppose when you are doing business, so there are a lot of inventories you hold. Like you are having a big showroom of say Marks and Spencer. So you go to the showroom, you'll find 100. When you ask how much money inventory you're having, they say 10 crores in one particular shop. So that is inventories. So inventories are basically the products which the company or raw material or the final product which have been made which has not been sold. Okay, so that will lie in inventories. Then receivables will be the money which company has to collect from its customers, so which not been collected. So it will be shown as other assets. So you will see all the total assets and total liabilities will always match. Is that okay? Now just look at this, so which was more relevant because this is part of our understanding and we must note it. Okay, so this is a balance sheet. Look at borrowings. Look at the borrowings. So this is right from 2014 till 2024. So this is balance sheet March. So and the last figure is September because now up to September the company has announced their results. Okay, so now October, November, December, company is going to announce the result in January. So that's why up to September the balance sheet of the company has been made. Okay, now look at the borrowings. How much was the borrowing in 2014? 1,38,000 crores. And what is the borrowing now? 3,57,000 crores. So that means company during the journey of last 10 to 12 years, it has increasing its loans. It is borrowing. Okay. So the borrowing has gone up from 1,38,000 to 3,57,000. Okay. Now this borrowing will actually they have to pay interest from where they have borrowed. They have to pay interest on that, and interest keeps changing. Okay. As I told you, if the interest rate goes up, the company's profitability will come down. Look at March 2024. and September 2024. Look at the borrowings. Have they gone up or gone down? Gone down. So all the companies would, most of the companies, of course, borrowing is good, but too much borrowing is bad. Because when I say that I have taken a lot of loan, so people say इसमें तो बहुत कर्जा है. So हमेशा जो है लोन जो होता है, leverage जो होता है, that is not considered as very good because you have to service the debt. You have to pay interest out of the profits of the company. Okay, if the company doesn't earn profit, how can it service its debt? Okay, so the companies which are not able to service the debts, they are in a very bad shape. Okay, now if you remember about 6 months back or a year back, there was kind of a allegation on Adani Group that they have borrowed heavily and the company is going to collapse by a report from Hindenburg, and they started short selling the shares in the market and the share price came down. Again, it happened a month back when they were indicted on some case in US, and of course they became free about for that their name was not in the list and the share price bounced back. Okay, so before we go into that, let's look at something more, and so that means borrowing is not considered as very good because that needs to be serviced. Now, how do you find the company is good or bad? Two numbers. Okay, one is the debt to equity ratio. How much is the debt and how much is the equity? So here it is 0.44. That means 44 paisa is debt and 1 rupee is equity, which is considered to be very good. Okay. If the company is having 5 rupees borrowed and 1 rupee their own money, very bad. भाई 5 रुपए उधार पे लिया हुआ 1 रुपया अपना लगा हुआ है, so that means they will be struggling to meet out their interest liability. Okay, and the company will be prone to kind of a disaster if the company starts making lower profits. Is that okay? So a 0.41, how it has been calculated? It's very simple. You go to the balance sheet again and just do one thing. Take the total borrowings, that is the debt, 357 divided by 818. Do that. ये लास्ट की फिगर है, आप इसको इग्नोर कर दो. 357 डिवाइडेड बाई 819 करो तो आपको 0.4 आ जाएगा. हमने बाकी की फिगर छोड़ दी, अगर रेशियो निकालना है तो इट विल नॉट मेक अ डिफरेंस. हाउ मच यू गेट टेकिंग 357 डिवाइडेड बाय एग्जैक्टली. सो दैट इज व्हाट वी आर गेटिंग हियर, इजंट इट? तो अब हमने ये देखा कि here we are having a debt equity ratio of 0.44. Okay, now this ratio, if it is less than 1, is considered to be very good for the company. If you look at the textbooks of all the textbooks, they say that it should be 2:1, but that is not, I mean, considered very good. So it is actually 1:1. One equity or one debt would be always an ideal, or even if it is less, there are companies which are having a zero liability. Okay, like suppose we saw a company like TCS, for example, which I said company doesn't have any liability. Okay, look at the debt to equity ratio, 0.09. So this company has virtually a very less amount of debt, 9 paisa of debt. Okay, fine, and 1 rupee of equity. Now let's look at, for example, company like Adani, some Adani company, Adani Enterprises. Here, what is the debt equity ratio? 1.92. Of course, this is one of the company which doesn't have much of debt. So here also the debt is 1.9 to 1 rupee of equity. So they are almost having a 2 rupees debt and 1 rupee of equity. Okay, so this is one ratio. Now the second ratio which is very important to look at is the ratio which is called the interest coverage ratio, which is 5.34. That means how much company is earning profit. Okay, and what is the interest they are paying? What's the ratio of that? So that means company is earning 5 times more than what interest they are paying. Okay, the ratio is generally very good if it is above 5 or 6 or 7. But if it is very less, 1, 2, the companies would be struggling to pay. Like for example, let's go to Adani again. Adani is how much having? Interest coverage ratio 3. Fine. So it is not so good. Okay. There are some companies will be having just very, like for example, let's see a company which I worked is now Vodafone Idea, which is in heavy debt. Vodafone. No. So Vodafone Idea interest coverage ratio तो minus कुछ आ रही है तो बेकार है, मतलब this is absurd number. Okay, for example, say any Adani company, Adani Ports and this thing, or Adani Power. अदानी एंटरप्राइज ही आ गया। Not changing. I think some stuck up with somewhere. Adani Power. So what is the interest coverage ratio? 5.89. So it's good, still good. I mean, almost like Reliance. Okay. So there would be companies which will be having an interest coverage ratio of say 1:1 or 2:1, which means they're earning very less, almost the same as what they're earning. So they can be in trouble. Okay. So when you want to see the financial health of the company, this interest coverage ratio should be above 5 or 6. Okay. If it is above a 6, then we say the company is financially healthy. That means it can meet out its liabilities, the interest. And how this ratio is calculated, just I will tell you that. See, this is what, how much is getting interest coverage ratio? 5.34. Okay. Now look at the profit loss of the company. This is the profit loss account. On the top, sales, then expense, then interest. So how much is the interest? 23,000. And what is the profit? 1 lakh operating profit of the company. So divide this 1,60,000 divided by 23,000. Of course, it will not give you exactly because that is the EBIT we take. Okay. It will give you somewhere around the same. कितना आता है? 160 divided. Huh? How much? 5 point? Okay. So normally we will get this from there. So of course it requires a little bit more calculations. It will not give you exact. So